Let me welcome all of you today to the Peterson Institute and say what a pleasure it is to introduce one of our own, Simon Johnson. Simon, of course, was the chief economist and economic counselor at the IMF until about 18 months ago. He then became a senior fellow here at the Institute, as well as returning to his previous professorship at MIT. And I think it's fair to say that he has been the most active commentator on the financial crisis over that period. We actually know because we keep tallies of those things here. And so I can report with empirical evidence that Simon has been the most active on all counts in responding to the crisis and commenting on many aspects thereof. He's also been one of the most, if not the most active blogger during this period. Simon's a big blogger. When he was at the IMF, he became the first chief economist there to have his own blog while at the IMF. When he left, in addition to going back to MIT, coming to the Institute, he set up his own blog called Baseline, which many of you have undoubtedly purveyed. He also blogs once a week for the New York Times. He's become a contributing editor to the Huffington Post, and so he's got a number of outlets of that type that engage him very directly in the policy debate around the world and, of course, throughout the country. Today, at Simon's background, going back to pre-IMF days, of course, was professor at MIT, was one of the developers of a key theme of development theory and analysis, the role of institutions, the role that they play in the development process. That, of course, has become widely accepted as one of the key explanations of the development process, and Simon was one of the lead developers of that thesis over the course of his academic career and his prior incarnations. The new book is called 13 Bankers. You have probably seen at least some aspects of it. Simon had a short version in the Outlook section on Sunday. It's been reviewed already in The Economist with lots of other reviews coming. As of today, there are a little over 50,000 copies in print. It's already into its third printing, although it's only been out for a week. It got up as high as number 18 on the Amazon bestseller list. It's been hovering in the 20s. We checked an hour ago, it was number 35. I hope it's not the negative trend. We're hoping today's lunch will reinvigorate it. In fact, it might. This is not an Institute book. This is a book that is published by Random House's Pantheon imprint, and so I can't give it to you. But you will notice on your way out, there is a desk. And if you are so inspired, you will be able to buy the book. And you will get Simon's autograph on it, as you wish, on the way out. He will be there in order to do that. And we hope that that will then drive the book back up into new record terrain on the bestseller list. And then we'll see if it makes the New York Times and other bestseller lists. They lag by a couple of weeks, so we'll see that over the next week or so. I say the book's only been out a week. This is Simon's first presentation of the book here in Washington. It's actually his first public event to lay out the book as part of the usual book tour. He did present it on the Today Show with Matt Lauer last Friday. He's had a number of interviews and many more coming, and I'm really very pleased to present him today. This topic of what caused the crisis, the role of financial institutions in it, the policy changes that are needed in financial regulation going forward are obviously one of the most important topics facing both U.S. policy and the world economy. Many of you were here. We had Paul Volcker to give his views on it last Tuesday. I think it's fair to say those are very consistent with the views that Simon will be presenting today and presents in his new book, 13 Bankers. So Simon, congratulations on the new book. We look forward to hearing you lay it out. Great to see you.
Well, thank you very much, Fred, for those very kind words. Thanks everyone for coming. What Fred was kind enough to mention some of the nice media coverage that we've had for the book. 13 Bankers. He did not mention that I was on Stephen Colbert's show last Tuesday. I'm not sure if Fred sees that as particularly confirming the legitimacy, but I can assure you in a certain demographic it's absolutely compelling. If you watch the clip, Stephen Colbert is hilarious, and I survive. And there was some discussion among my colleagues afterwards about this, and one colleague who wasn't here said, well, Simon only survived Stephen Colbert because we have our intense Friday lunchtime discussions, and it's, you know, sink or swim. And that's absolutely right. This is a wonderful place to do research, to work on analysis, and to think about public policy. And it's a very intense place, and so it's a place that's all about debate. It's all about hammering out the ideas. And I think that if this book gets any traction at all, it is due in large part to the generosity, intellectual generosity, and intellectual atmosphere created here by Fred Bergson and all my tremendous colleagues here. So let me talk about the book, which is joint with James Clark, who unfortunately couldn't be with us today. He's selling the book in another town. And let me call this 13 Bankers and the Next Financial Meltdown. Of course, there's plenty of books out and coming out on the crisis of 2008, and that is part of our story as well. But this book is very much oriented towards the future. It's very much asking what comes next and what should we learn from not just 2008 but the previous 20 or 30 years. Actually, going back, in the chapter 1 of the book goes back to the beginning of the American Republic and goes through the history of the relationships between politics and finance in this country. I'll touch on that a little bit. But let me focus mostly on today and on the picture going forward. So I think one way to sort of crystallize the issues and to think about, you know, is this really a big deal or not, is to take up what one of the things Secretary Geithner is saying recently in his quite extensive and quite successful public relations push, saying, you know, we encountered a 40-year flood. Sometimes he says 30 years, sometimes he says 40 years. The point is, it doesn't happen very often. We should do things to fix it, and that's where the administration certainly is today. But this is not a problem you should expect to occur with great regularity. Now that's an interesting statement and a very important statement, and I would contrast it to some degree with what is in Hank Paulson's memoir, where he talks about crises of some kind occurring every 4, 5, or 6 years. It also contrasts with what Jamie Dimon, the head of JP Morgan Chase, typically says, you know, again, crises every 4, 6, 7 years. And even Larry Summers at some moments talks about crises being a more or less 5-year intervals. Now, you could reconcile these things and say, well, look, Simon, those are crises, shocks, disturbances somewhere in the global system. What Secretary Geithner is focused on is the huge shock, financial catastrophe, and near meltdown of the financial system that we experienced in September 2008. And I think that is an interesting potential reconciliation. But Secretary Geithner's conception of this really requires you to believe that this is just, the structure didn't really change, we get these random shocks, occasionally they're really bad. What if, instead of that, we look at the details of the structure of our financial system, which is what we do in the book, and we start to become concerned that that structure has changed over the last 30 years to become more vulnerable to these regular global shocks in a way that brings the US financial and economic stability into question. So just as a way to illustrate this, or a way to start thinking about it, this graph shows what has happened to the federal funds rate as we've gone through from 1980. It's come down obviously in part because inflation expectations have come down, part it's a recognition of the success of that dimension of monetary policy. But it's also come down in the aftermath of every, or in reaction to every financial disturbance. And of course this used to be, the term that was used in financial markets to describe this was the Greenspan put. I think people regarded that as somewhat humorous initially. I don't think it's very funny anymore, personally. And you can see where we've come to is that federal funds rate went down to 0, as you know, close to 0, and the Federal Reserve had to improvise a number of measures around so-called quantitative easing that may or may not have helped the economy turn the corner. Personally, I hope they've worked. But one question you might have from this picture, for example, is what happens next time? So if interest rates have already come down this low, and if we already push the envelope on quantitative easing, how confident are we that the next time we'll be able to offset the shock with monetary policy? Or, of course, not in this picture, fiscal policy. I think the costs of this crisis are enormous, both in a human dimension, that's 8 million jobs lost, but also in the fiscal dimension. I would not at all agree with the administration's attempt to quantify the effects of the crisis in terms of whether or not you make money or lose money on top, on the injection of capital, more specifically into banks. I think the fiscal cost of this is the increase in net government debt held by the private sector, which, by my estimates, which are not exactly the same as the CBO's estimates, but the CBO is moving in the same direction. My estimate is that debt to GDP, roughly speaking, net debt will rise from around 40% of GDP to around 80% of GDP as a direct result of this crisis. That's a very big fiscal cost. And you also have to ask yourself, see, the other graph, the other line here is private sector credit to GDP, which, as you know, is not at all an adequate representation of how much more important credit has become relative to the economy, but this captures at least the right trajectory. I mean, it's not correct because the derivatives are not there, and we haven't found good ways to put off-balance sheet credit together with balance sheet credit. But you know very well where that picture's going, and you have to ask yourself this: next time, if there is a big shock, and if there is a big collapse or threatened collapse of the financial system, how confident are you that the monetary policy response will be there, or the fiscal policy response? The historians have looked at this, estimate that in 1930, if the federal government had wanted to do what we now regard as the right kind of fiscal response, it probably could have mustered about 1% of GDP. It was a small government. The financial shock was bigger. There's nothing that I'm aware of that says the size of financial shock will match your ability to offset it with fiscal policy. In fact, you can look at the experience of Ireland, or if you want to go very extreme, Iceland, and we can argue about other places like the UK. In Europe today, these are warning signs that we're moving beyond the too big to fail issues that I'll talk about more in a moment, towards too big to save. And maybe it's not a random, once in a while thing, but a loop, or a cycle, or what Andrew Haldane of the Bank of England now calls a doom loop. Now, Fred always impresses upon me the importance of keeping personalities out of it, only talk about policies. And I completely endorse that. The book is about policies. And the book is about the structure of the system. There is no conspiracy here. Let me be very clear. A couple of reviewers have misunderstood the book. I think they didn't actually read it, but that happens. And they say, oh yes, it's a conspiracy theory. There's no conspiracy here. This is a system of incentives and beliefs that we have all created, and which I think became apparent to many of us more clearly from 2007 through to the present. So this is a system, but I must admit, Fred, it does sell well to put people's pictures on it. And people want to talk, people want to ask about who were the individuals who were responsible, who played these various roles. So Dick Fuld is in the top right. And this is about reckless risk-taking. Adair Turner is to the right in the middle. Regulators are aiming to prevent excess. Certainly he is, and we can argue about the extent to which other regulators have played that role. But there has been, Secretary Guidance picture is at the bottom just by coincidence. Next to where it says regulators captured by the industry. I'm not sure who put that there. There has been, let us speak in the polite language of the IMF's multilateral surveillance, there has been regulatory capture in this country. In fact, to be honest, I mean, George Stigler, who's the originator of the idea of regulatory capture, Chicago economist, Nobel Prize winner. This is very much the tradition we're coming from, not a left-wing radical, to the best of my knowledge. He was very worried about this in terms of how specific industries are regulated in the United States. What we're seeing now, I think, in the US, because finance has become so big and so influential, is a Stigler on a grand scale, or actually something that approaches what we are not at all comfortable with discussing in the United States, but we know it when we see it in other countries. We talk about state capture. We talk about a certain set of people, a certain sector, having become so powerful that it can really bend the state and the force and the power and the money of the state to its own ends. So what happens when you have capture? Well, there are losses, and here we have Ben Bernanke, Larry Summers, with Abraham Lincoln behind him, appropriately enough, and Mervyn King. Mervyn King holding his head in despair. I think they're slightly in mock despair, but he's getting his point across. Mervyn King, of course, Governor of the Bank of England, said last October, never in the field of human financial history has so much been owed by so few to so many, and with so little prospect of real reform. That's Mervyn King. And then you come to the top, where we have Jamie Dimon with his fists up, Lloyd Blankfein, and then of course the other bank CEOs testifying. And the extraordinary fact, just extraordinary fact, that of the 13 bankers who were called to the White House in March of last year to be saved, and of course the government had to save the financial system. This economy would not function well, if at all, without a financial system. But these 13 bankers were saved completely. Their jobs were saved, their pensions were saved, their bonuses were saved, their boards of directors weren't even touched, despite all that they had overseen. Their staff remained in place. They were told to be more careful, and it is true for about 20 minutes after that meeting, they said nice things to the cameras. But as you know from the latest numbers, 2009 is the highest year on record for Wall Street compensation, not executive compensation, but Wall Street compensation. John Stumpf, the CEO of Wells Fargo, not to pick on anyone, Fred, but just as an illustration that was in the newspapers this week, John Stumpf got a huge cash payout, a tripling of his cash salary by some estimates. And when questioned about it this week, a Wells Fargo spokesperson said, well, we had a very good year in 2009. Actually, they didn't have a very good year in 2009. The financial system was saved in 2009 by the taxpayer, by the Federal Reserve, and saving it made sense. Look, we say this in the book very clearly. We have a blog where we argue these things out day by day. We are in favor of saving the financial system. We asked the question in the book, did it have to be saved in this form? Was there no opportunity for reform at that moment? And, you know, there's two answers to that. One is that the administration was too nice to the bankers on that day, and I will concede that's the way we lean in the book. But there's another answer which I think we should take seriously, which our colleagues in the administration put to me very directly. They say, look, we had no alternative. There was nothing else we could do. If we'd even ruffled a feather, okay, they don't say ruffled a feather, but if we'd even fired a single member of the board of directors of Citigroup, for example, that would have caused a much greater panic, it would have undermined confidence, it would have deepened and prolonged the recession. I don't think that's actually accurate. But if it were accurate, think about that. What does that tell you about the nature of the financial system and the hold that our biggest banks have over us? If they managed, in 2008, 2009, they managed their way into a position where they had that kind of power, if you fired any of them, a single CEO taken out, catastrophe would have followed, my administration friends say. That's incredible. If true, and I think they do think it's true, they do feel it's true, that's blackmail. That's extraordinary extortion implicit in the system of incentives and beliefs that existed prior to 2008 and is now actually been reaffirmed. Step back in history a little bit. Where did this come from? How did we get to this point? This is a picture based on some excellent work by Thomas Philippon and Ariel Reshev, who look at compensation and financial regulation going back as far as you can go, which is to 1907. And if you look at the right-hand part of the picture, you see what has happened since the 1980s is there was a series of deregulations, the abandonment of regulation, which happened in steps. In the book, we go through that in somewhat gruesome detail. And at the same time, finance became extremely well paid. The dotted line is the financial regulation. The solid line is relative wage in finance compared to private sector wages. And you can see the interesting thing between the 1940s and the end of the 1970s. Banking, finance was not that well paid. I mean, it was a good job. It was, known as banking was known as a 3-6-3 profession. Pay 3% on deposits, lend it out at 6%, and be on the golf course by 3 o'clock in the afternoon. Now, it wasn't a bad job, don't get me wrong, but it wasn't the dynamic, exciting, money-making machine that it became after the 1980s. This is deregulation, which of course started under President Carter, picked up speed under Ronald Reagan, and in large part this is the Reagan Revolution applied to finance. Personally, I'm in favor of some of the forms of deregulation that were adopted. I'm particularly fond of cheap airfares, for example. But it doesn't follow that because deregulation makes sense in the real economy, or for parts of the real economy, it necessarily makes sense for finance. In finance, it has gone too far. In finance, it has created a system that is dangerous. Go back in history a little bit further. Go back to the 1930s. And it's very interesting. At the time when the FDR reforms were brought in during the Great Depression, finance was a very well-paid sector. It was a much smaller sector as a percent of the economy, by the way. The best estimates we have before World War II, it accounted for 1 or 2 percentage points of GDP. Now it's more like 6, 7, 8 percentage points of GDP. But this was a well-paid sector. And regulation absolutely reduced the money in the pockets of the people working in that sector, and it reduced the economic power of that sector. And if you were to re-regulate, and if the re-regulation were to work, I would expect relative compensation would also be affected, which of course is a very big reason why it will be resisted tooth and nail. And of course the important thing about American politics really is, and we go through this repeated cycles, as Fred said. We had a piece in the Washington Post this summer talking about Teddy Roosevelt and talking about previous iterations of the conflict between elected democracy and a president who wanted reform and concentrated financial economic power. In that case, Teddy Roosevelt took on J.P. Morgan and won, and then started the antitrust movement. We can't go back that far in the data, but we can go back to the 1920s, and we can look at what's happened to real corporate profits, financial and non-financial sectors. This is an index. In 1980 it was 100. This just shows you how the profits in those sectors changed, and it shows you this massive surge in profits for finance relative to 1980 that happened, and again, associated with deregulation. Now, this is an extraordinary picture, and if you haven't seen this picture before, or a version of this picture, you should spend some time with it, either in our book or on our website or in the other versions that exist. And I would also say, in terms, it's not shown in this picture, but in terms of the relative share of finance in total corporate profits, Larry Summers himself flagged this last year. He said, in 2003, financial sector reached 40% of total corporate profits in the United States. That should have been a red flag. Those are Larry Summers' words. And he's right. This is an intermediate input. This is a sector that we have in order to enable us to do other things better, like save more effectively, allocate capital more efficiently around the economy. It would make sense that from time to time it has higher profits, but to have these prolonged higher profits over this kind of time frame is unusual, to say the least, and it suggests that something untoward is going on either in the market structure, or perhaps in both, in the market structure of this industry, and also in the way that we're accounting for profits. So for example, if you make a lot of bad loans and you don't properly provision for them, you're going to show high profits initially, and then that'll catch up with you. If you could see down the end, of course in the fourth quarter of 2008, financial profits fell sharply, but then they rebounded. 2009 was a very good year for the financial sector in terms of recorded profits. That's part of the recovery strategy. That's a manifestation of the forbearance that this administration has shown towards the financial sector. But that's also the money they spend on lobbying. Now, Larry Summers himself on the weekend talk shows berated the financial sector. I think he said they're spending $1 million per congressman. They have 3 or 4 lobbyists. Neil Wolin, Deputy Treasury Secretary, gave a fiery speech to the Chamber of Commerce about 2 weeks ago now, where he said you're spending $1.4 million per day to fight against the financial reform legislation. And this financial reform legislation, in case you didn't know it, I think is rather too weak. All right? At least on the systemic too big to fail issues. The part of the fight with the administration is obviously about consumer protection, which we can discuss separately if you want. But even legislation proposed by their friends, proposed by the people who save them, right? You might think of it as the quid pro quo for this incredibly generous bailout. Well, you might think of it that way, but Wall Street does not think of it that way, I can assure you. Wall Street sees it as something to oppose tooth and nail. And that's what Treasury is now objecting to, and that's what the White House is now objecting to, I think with some good reason. But they have lots of money. The model, look, think of it this way. Jamie Dimon's job description, Jamie Dimon, head of JP Morgan Chase, his job description, I haven't seen it, but I can assure you, it says nothing at all about global financial, sustaining, maintaining, being responsible for global financial stability, or particularly for protecting consumers in the United States. It's not his job. His job is to make money for his shareholders. It is the job of the government, of the executive branch, the legislature, and the regulators to prevent finance from getting out of control. And they failed repeatedly and, honestly, completely. And now the administration's best idea, the best idea of Senator Dodd's legislation, is that we'll put the regulators back in charge and have them do a better job going forward. Well, that's a complete non sequitur as far as I can see. That's not what the history has been of the past 30 years. That's not what the power structure points towards. That's not what the ideology of finance suggests. And I find, I'm sure present company accepted, that the ideology of Wall Street is pervasive and prevalent in Washington. Actually, I'm sure that's true of everyone who buys my book, so if you want me to. And finally, in conclusion, where are we today relative to where we were before the crisis? Well, this is another extraordinary fact that you should spend some time with. And all of these slides, I would say, will be on my website afterwards, and there'll be a link from the Peterson website. So you can look at these, you can download them, you can send them to your colleagues. You can send them to Chris Dodd, actually. Although Senator Dodd did tell Don Imus earlier this week that he's reading 13 Bankers. Yeah, I don't know how much good that will do us, but I thought it was encouraging. The biggest six banks in this economy are bigger now, and I'm talking about assets relative to GDP. They're bigger now than they were before the crisis. They're about 63% of GDP, the latest data we have from 2009. They were 56, 58% of GDP before the crisis. If you go back to the mid-1990s, they were 17% of GDP. Now, I would stress there is no evidence, and we go through this carefully in the book. I've talked to a lot of people who work in this area, both on the research side and on the practical side. I've had many discussions with people who are taking the opposing view. There is no evidence of gains for society. And I think Paul Volcker made this point, I understand, last week at this podium. There is no evidence of benefits to society of an increase in bank scale above $100 billion. Now, Citigroup, if you remember, was about $2.5 trillion, if you include the off-balance sheet liabilities they had to bring back onto the balance sheet. $2.5 trillion before it failed. I'm sorry, it ran into liquidity problems, I forgot. It ran into liquidity problems in fall 2008. There are obviously private benefits to building a bank in the trillions of dollars. In fact, Jamie Dimon says to his shareholders, very clearly in his letter to his shareholders this week, that if we're good and we win and we get bigger, that should be allowed, and we can get as big as we want to be. Yes, that is good for Jamie Dimon, and it may be good for his shareholders. We can debate that. That's an interesting question. It is not good for society. There is no evidence that it's good for society. The only studies I know that even point in this direction are studies currently in progress that have been commissioned by the big banks. So we'll see how they turn out. But seriously, there's no evidence of social benefits, and we know what the social costs are or have become. 40% of GDP, increase in debt, 8 million jobs lost. The Federal Reserve pushed to the limits of its credibility, and actually, I would say, forced to take actions that have caused it a lot of trouble on Capitol Hill and may end up undermining the independence of the Federal Reserve, which could well be the biggest cost of the entire operation. And we haven't fixed it. It is not fixed. We can argue at length about whether or not too big to fail was a big issue before 2008. Okay? We can argue about whether various institutions thought they were or were not too big to fail. Now I can assure you, they know they're too big to fail. If Goldman Sachs hit a rock today, what are the chances they will be allowed to fail tomorrow or on Monday? There's zero. Absolutely zero. Bankrupt? Goldman Sachs? Impossible. Goldman Sachs' balance sheet fluctuates around $800 billion. The largest financial institution we let go bankrupt, unimpeded, last year was CIT Group, which had a balance sheet around $80 billion. 80 versus 800, 800. Goldman Sachs, from a too big to fail perspective, is, roughly speaking, 10 times too big. And what we propose in the book is to update and amend the Regal-Neal Act of 1994. Regal-Neal Act attempted to set some very sensible limits on the size of biggest banks in this economy. It said no bank can have more than 10% of total retail deposits. Two problems with that. One, The action since 1994 has not been in retail deposits, it's been in wholesale financing. So that didn't really count. And secondly, it turns out there are some loopholes that certain regulators can interpret so as to create a hole big enough to drive Bank of America through. So that didn't work. But that idea of setting a cap, of having a legislative cap and forcing banks to comply with it, let's say over a 3-4 year time period, that's entirely sensible. It's prudent. And there are people who say, no, Simon, we don't want to do that. We'll just have effective regulation or smart regulation. Well, being opposed to effective smart regulation is like being opposed to having a tasty dinner. I mean, of course I want effective regulation. If you can tell me how to get effective regulation in this political environment with this amount of power for the big banks, with this kind of ideology, and then we can have that discussion. In any case, these are not substitutes. Why would you think these are substitutes? They're complements. You want a system with fail-safes. You want a system that attempts in multiple ways to contain the damage that can be done to society by a financial sector that's gotten out of control. This, reducing the size of the biggest banks, and our size cap would actually push these biggest banks back down to where they were in the mid-1990s, when, by the way, they were well-run banks that competed globally and did just fine in terms of providing services to the non-financial sector, which I suggest should be our litmus test. They could do it again. They deny that this would work, but John D. Rockefeller denied. John D. Rockefeller said in 1912, if you break up Standard Oil, there'll be catastrophe. Oil was the lifeblood of that economy, manufacturing economy. It was at some level a terrifying thing for policymakers to take him on because of the power, because of the damage that could be done if you got it wrong. They broke up Standard Oil into 35, 37 pieces. Hands up, and most of those companies exist today, have done very well. Hands up who'd like to recombine them all into one monopoly. Yeah, thank you. Yes, one guy at the back. There's always a guy at the back. Are you a Rockefeller? No, the Rockefellers did. What a great American thing. The Rockefellers did well out of it. They also built Williamsburg, which my kids really like. It was a great reconciliation. That happened because Teddy Roosevelt took them on. In 1902, J.P. Morgan came to the White House. Teddy Roosevelt was suing Northern Securities, a vast railroad monopoly, suing them for a breach of the Sherman Antitrust Act, which had never been done before for industrial trust. Nobody knew why Teddy was doing this. Nobody thought he was going to win. The Senate was called the Millionaires Club for a reason. And there was no theory that even said this was a good idea. Modern antitrust theory came afterwards. J.P. Morgan came to see Roosevelt and he said, if we've done anything wrong, send your man to see my man and we'll fix it up. And Roosevelt and Philander Knox, as Attorney General, said, no. We don't want to fix it up. We want to stop it. And from 1902 to 1912, the mainstream consensus shifted. People like you, 100 years ago, in 1902, would have been stunned when Teddy Roosevelt announced he was suing Northern Securities. By 1912, people like you would have overwhelmingly agreed that Standard Oil should be broken up. It's that shift in consensus that we're aiming for. That's why we wrote the book. To persuade people like you, not today, not tomorrow, but take it away, argue with your colleagues about it, push back, start your own blog. Please, we need more blogs. We do, good blogs on these issues. Actually, somebody started a blog just this week called The 14th Banker. So you might have to go for number 15. Have the argument, have the debate. The consensus has to shift. And as you know, the consensus does shift. It shifts all the time. We update. That's the great thing about this democracy. We have the argument. We move opinion. And I don't think this is going to get fixed on this legislative cycle. I do hope there's going to be a big debate in the Senate. I do hope the country will be engaged, energized. I do think that a lot of the populist anger on this issue is legitimate and should be channeled in a productive direction. I do think it's dangerous if you ignore that feeling in the country. But let's have the debate, let's have the argument, let's try and move the consensus in a productive direction. It is crazy and irresponsible for 6 banks to have this kind of hold over all of us. It will damage our economy, you'll see it in your taxes. Your children will feel the adverse effects. Let us fix this now. Thank you very much.